Hello, I'm Brian Stafford, CEO of Diligent Corporation. Welcome to today's discussion on the changing tax landscape, and in particular, the call for a 15% global minimum corporate tax.
Globalization and digitalization revolutionized our economies and societies. They've also challenged the viability of the global tax architecture for both business and governments. The OECD has long been at the forefront of global efforts to tackle tax evasion. Globalization has exacerbated unhealthy tax competition. As of today, 134 countries representing over 90% of global GDP have joined a statement on a two-pillar solution agreed to in July, which addresses these issues. Pillar 1 modernizes outdated rules to ensure a fairer distribution of profits and taxing rights among countries with respect to the largest multinational enterprises. Pillar 2 provides for a globally agreed effective minimum corporate tax rate, which countries can use to protect their tax bases.
Never before have we had major U.S. tax reform simultaneously with global international tax reform.
Even before COVID and the pandemic, the search for revenue was already well advanced. It's been exacerbated, obviously, by the huge deficits brought on by COVID. But right now, people are looking at companies that aren't paying much in any taxes. They're looking at people that operate in low tax jurisdictions. And there's a sense of inequity here, I think, that OECD is also trying to address.
And so the bottom line is we're expecting a big framework in October with lots and lots of pages that we're going to digest and hopefully more clarity on how these rules are going to work, because the business community really needs that so that they can understand it. And so the bottom line is that 140 countries would then have to adopt these rules in their local tax codes. So I just want to make sure you understand the complexity of this, that 140 countries would have to take the framework and then adopt the rules. And so that's not a short undertaking. This will take some time, even though there's a lot of ambitious statements that this should be done in 2023 and done quickly.
And I think, countries such as Ireland, such as Singapore, that don't have some of the structural advantages that the United States does, or most of Western Europe do, they have used their tax rate as a competitive leveler. And I think that desire of these individual countries to continue to seek advantage through tax rates when they can't compete, for instance, on infrastructure, they don't have the amount of talent, they don't have the energy infrastructure, perhaps, of the U.S., they need to be able to compete. And by taking away this lever, I think it irreparably harms those smaller countries that are otherwise less competitive globally. And for that reason, I think it's unlikely we're going to get all 140 countries to agree.
Well, there's a lot going on for companies to absorb. And so the number one thing we recommend is you have to have a really great model, and you should be modeling this out, because it's really the unintended consequences that might surprise all of the stakeholders. And so the devil's in the detail.
And at the end of the day, when we talk about taxes, when we talk about it is in terms of U.S. competitiveness. We want to have the most competitive environment in which to operate. We don't want to be at a disadvantage to our foreign competitors. And so as we go out and talk to the folks on the Hill, we just try and make the point is, it's okay. We don't mind paying taxes. We all have an obligation to pay taxes. We know we need revenue. Let's just do it efficiently and fairly that doesn't disadvantage U.S. multinationals versus our competitors. And I would encourage all of you that are on corporate boards to make sure that you're out there talking to these same folks, making sure that your companies are doing the modeling that Kate referred to really understand what the impact of these huge changes could be.
A lot of companies since the pandemic hit have really had to sort of find their employees, because employees are working from second homes or VRBOs or whatever, their location might be. And what's happened is that can create unintended tax consequences. The company might have a nexus in that location that they hadn't had before. So that is something that now companies are using technology to track that better, trying to match up with their HR policies and just do a better job of knowing where their employees are when they're not working in the office.
Well, I think you have to really look at this whole $3.5 trillion spending bill in conjunction with the tax increases that they're proposing to pay for these spending increases. But there's both spending as well as penalties on utilities, for instance. If you don't convert 4% of your generation to renewables every single year, you pay a penalty. And again, 4% is a lot, since I think in the last 5 years, we've averaged about 1.5% increase in renewables.
So a lot of leading economists right now say that raising taxes has to be done at a time when the economy is quite stable, if at all. You know, there's a lot of leading economists who will say that it's the worst thing you can do in terms of encouraging businesses to grow and get more people employed. And so, you know, what the worry is this too soon? I mean, we're still navigating this pandemic. We're not through this health crisis. And so the timing could be a bit early.
Let me just be very, very specific here. I think the message for this audience is one of, it's not too late to make a change. The bus is about to go off a fiscal cliff, and it's going to do irreparable harm to this economy. But if you can get your folks talking to the folks on the Hill, get your suppliers, get your customers, and help educate them in terms of what the impact of this legislation would really mean for them, I think we can turn this bus around, and I think we can stop it before we make a big mistake.